So we start. I was saying that the IASB framework provides the underlying rules, conventions, and the definitions that underpin the preparation of all financial statements, which are prepared under the International Financial Reporting Standards. So there is a conceptual framework that is used even when you want to come up with a new standard, or when you want to modify the existing standard. Obviously, in modifying the existing standard, what you're trying to do is to improve that existing standard. Because over time, these standards, they start becoming obsolete. Crooks start using them to manipulate the system. I'll give you an example of IFRS, of what used to be called as I-17, which is on leases. Most of these financial analysts who are crooked and their bosses, they would use that to hide most of their obligations.
Yeah.
So instead of actually looking at a lease as a financial lease, they would take it as an operating lease.
Yeah.
Therefore, hide the obligations.
It's true.
Then if you buy this particular business, you realize that it has so many encumbrances which were off balance sheet. But later on, after discovering that this particular standard was being used to manipulate the real picture of the organization's financial position, they decided to enhance the standard by coming up with what they called as IFRS 16 on leases, meaning that you have no option but to show your obligations on your leases. So that's why we are saying it ensures standards developed within a conceptual framework. So there's a defined way in which you can actually create a standard.
Yeah.
Secondly, we are saying a standard could be there, but it has a lot of gaps. So you can use this framework, Yvonne, to try and enhance the standard, try and improve the standard. Thirdly, to ensure financial statements contain information that is useful to users. I regard those that are mandated to prepare financial statements to have even a much bigger responsibility than a medical doctor. A medical doctor, one blunder will kill only one person. These guys that prepare financial statements, if they want to mask the problems the company is going through, they would be risking thousands and thousands of people, those employees who work there, even the people that depend on those employees. In an event that the company collapses because they were trying to mask the performance of the company, giving an impression that the company is doing fine. So that is how I always look at the people that prepare these financial statements, the people that do all these analysis here and there, that they have a very bigger role to play in society, which maybe could even be more than a medical doctor, because a medical doctor will only kill one person. Financial crooks like Madoff, who was actually in prison for 150 years, would kill the whole society. And that is how I look at it. Fourth, it helps prevent creative accounting. I've already mentioned how experts and ethical experts would use the weaknesses of these standards to perform creative accounting.
Just a minute. We are fighting for the phone home.
Huh? Oh, okay, okay.
I tell you at home.
Yeah, it's understood. Give her the phone. You have a laptop, isn't it?
I'm using a laptop now. I'm using the internet from the phone.
Yeah, but she can still have the phone. She can hold it. There's no problem because you have
Charging.
Oh, okay.
Okay, we can continue.
Okay. So here, what I was actually trying to say, let me do this. The beauty of technology. So when you are actually looking at these standards, the conceptual framework, I mean, so on the conceptual framework, there are about 4 things that we have actually mentioned why this is needed. One, we're actually saying that what new standards are developed within a framework. New standards are developed within the framework. So in terms of theory, you have to make sure that you get all what is supposed to be gotten. So that is one thing. Secondly, we said, yes, if you're coming up with a new standard, what do you use? You need to have an established, a defined, a structured a framework that you can actually use. Yes. Mr. Levy, I'll call you. I'm in class. Huh? I'll call you after 1 hour. Yeah. Thanks. So look at how you develop these thoughts. So you're saying there's a new standard. You want to come up with a new standard. Obviously, you need to actually look at the framework that supports the development of that standard. That's the first thing. Secondly, you already have a standard. All you need to do is to enhance the standard. So here you're actually looking at existing standard. So your aim is to just improve the standard. And this is why you're actually using, this is the reason why there must be a conceptual framework, which you all agree that this is what we are going to use in trying to improve any existing standards that are there. I failed. Try to, yeah. So you have that. So thirdly, what you look at also is to ensure that financial information, financial statements contain useful information. Oh, I'll do like this, or say, the financial statements, obviously, I've just tried to have it written in a wrong way, but to ensure that the financial statements contain useful information. Fourth, you're actually saying, oh, just a minute. Sorry, I had a bit of distraction.
No,
Kids
it's okay.
at home, yeah.
Yeah,
So,
I tell you.
yeah. So the fourth thing is about creative accounting. Seeing opportunities for accountants to use creative accounting. Of administrative government. What options are there? We'll see when you come back from demo. I'll check. I don't know. Yeah, you're going to them. Unless you don't want, I've given a man. You're going to help her to choose things. Meet what, not this is with it. So the aim here is to prevent this. So there are 4 things here. We're actually saying new standards are developed within the framework, existing standards. Whenever there's need to improve the existing standards, so you use this conceptual framework to improve your standard. Also, to ensure that the financial statements contain useful information, which could be used by users for decision making. Because you have a lot of accounting, users of accounting information, and that information, that the accounting statement, those financial statements need to contain relevant information. Then to prevent crooks to explore the lacunas that these existing standards may have by doing what we call creative accounting. Any questions out this far?
It's clear. It's okay.
So what's the objective of financial reporting? Why do we need financial reports? Remember that the users of the financial statements or financial information, they are varied. They are from diverse backgrounds. Some are lenders, others are investors. You have employees, you have the government, you have the customers, you have the suppliers, you have interest groups such as lobbyists and all these. So it's to provide information that is useful to existing and potential investors, lenders, and other creditors in making decisions about providing resources to the entity. For employees, if they are able to be able to read these financial statements and realize that the company is actually going into the drain, they can as well start looking for employment elsewhere. So there's need to give this information in a more credible way, and these are the things that we'll be looking at, qualities of good information. But currently, we are saying that's the first objective. Secondly, is the economic resources of the entity, because it clearly shows on your equity, it clearly shows the resources of the company. But it also gives you, because if you are looking at that, you are looking at it from the asset side, from the equity side, and the claims against the entity. The claims against the entity, you will actually be looking at liabilities that you have. These liabilities you have, they are actually claims against the entity. So the changes in the economic resources and claims, just that, it actually shows whether the company is generating value or extracting value from its activities. Because then you're actually looking at assets against liabilities. In a situation where you find that current assets, for example, are higher than the current assets, the current liabilities are higher than the current assets, then you know that the company is actually becoming very liquid. It's becoming more scary. So what are the underlying assumptions? For any organization, the underlying assumption that this company that you have shall continue being in existence for a foreseeable future. Or you are actually saying that you have no plans at management, either to curtail operations, to slow down the scale of your activities, or just to completely close and divest. So you're actually saying this company is a going concern. And mostly when statements, financial statements are prepared, one of the pointers that shows that this company indeed is a going concern, before you start looking at the problem that the company has, is depreciation. As long as you're depreciating your assets, or you're actually saying that you believe that these assets, they will continue giving you economic benefits, or economic benefits will continue flowing to your organization, or you are actually saying that you have no plans to stop, to sell the company. That's the first line. That's the intention of management. But there could be, as you do your analysis, you realize that this company, as much as they still want it to be alive, it is basically in a ventilator or in the ICU. The going concern of the company is questionable. Vera. Second, so I think the going concern principle is the assumption that an entity will remain in business for the foreseeable future, and we have explained that. Because if you're trying to curtail certain operations of the business, you might as well have these assets, that your assets be classified under IFRS 5, which is basically assets held for sale. Secondly, an entity is assumed to be a going concern in the absence of significant information in the contract. That's what I've explained to you. But the moment you start looking at this information using your microscopic eye, you realize that the company might not actually have a life. Therefore, it's not going to be a going concern. So an example of such contrary information is an entity's inability to meet its obligation as they can't due without substantial asset sales or debt restructuring. So if a company cannot meet its obligations, where instead of paying its obligations from EBITDA, for example, from earnings before interest, tax, depreciation, and amortization, because that is your operating cash. So a company starts failing paying its obligations from EBITDA. It starts now borrowing from John to pay Mary, so that you have some space again to go to Mary to borrow. Then you know that the sustainability of this company is questionable. Or you start thinking of debt restructuring. Because at any given time, you think of debt restructuring, meaning that debt has choked you. So the question that other financial analysts and experts would ask is, why were you failing to sculpt your debt to know that the debt that you have gotten is unsustainable, you have challenges to start actually amortizing this debt. So we now look at qualitative characteristics, make information useful. So what are these characteristics that would actually make? What are these characteristics that would actually make your information very useful? So first we look at the fundamental qualitative characteristics of good information. One, information has to be relevant. Information that makes a difference to decisions made by users, nature and materiality. If you have information that cannot even give a dent to what you want to achieve, that information is not worth having. That information is stale. Faithful information. When we say, yes, the information is relevant, but it has to be faithful, meaning that this information has to be very complete. It should help understand and include descriptions and explanations with no bias whatsoever and free from error. Then it means that this information is faithful, it is complete. It has all the necessary explanations that you want. Because information that has bugs or errors, you cannot trust, it's not faithful information. So when we look at fundamental qualitative characteristics of good information, is that information has to be relevant, it has to make a difference to decisions that you are going to make. Secondly, this information has to be wholly faithful with no room for error. So enhancing qualitative characteristics. Why you actually need information, or we need now to look at the characteristics that make information to be very good. You should be able to compare information. This data has to be compared. Last year's information to this year's information, so that you can actually draw some interesting inferences from there. So I think identify similarities, differences between entities and year on year. So we can use year on year. We can also look at one entity against the other entity. But we need to have information that is comparable. Other than that, information has to be verifiable. So verifiability of information is very key. It assures the information represents the economic phenomena it represents, because this information can be verified. Information that cannot be verified cannot be trusted. You might also question whether it is faithful information, because you cannot verify it. So when you look at these audited financial statements, is that we are able to compare year on year. We are able to compare this company against the other company because it's comparable. But we are also able to verify this information. And this is what auditors do. They would ask for the list of the payables, the suppliers, so that they check the list of the suppliers and the amounts that are there, whether that tallies with what you have in your financial statements. Timeliness. So information is less useful the longer it takes to report it. you come up with financial statements that should have been issued, say financial statements, say for activities in 2018, then you issue the financial statements now. What good is in there? It has taken long. Information has to be timely. The more timely the information is, the better it becomes, because then that information can be used for decision making. Always think of this, Yvonne, where you applied a certain job, you applied for employment at some company. For example, you actually applied at Barclays 3 months ago. So you're expecting to receive maybe some invitation of some kind to go for interviews. So instead of receiving that information, that particular request this month, it takes another 2 months. But it's when you receive the documentation shows that you should have actually attended the interviews maybe a month ago. That is not relevant now because it's not timely. It has actually been overtaken by events. So other than that, information has to be, you need to be able to compare this information to verify the information, because verification is more about ground truthing. Is the information timely? Also, this information has to be in a language that you are able to understand. It shouldn't be in the George Mpombo's language where when you are with him, you don't understand anything if you are trying to communicate. So this information has to be understandable. So the users have a reasonable knowledge of business and activities. Elements of financial statements. So when you look at the financial statement, I always tell people that when you look at the financial statement, let me just draw something here. So when you look at the balance sheet, what you now you call statement of financial position. Don't mind my handwriting. That was my handwriting. So now you have the first part of the balance sheet is basically assets. So the second one here is about equity. Then you have the third one, which is the last part. So here is about equity. Then down here, it's about liabilities. This is where you have your obligations. So one thing that we need to understand, when we are actually looking at this, we are actually looking at the I's, and the ears. So down here, this is where you have your gossip. And I'll explain this in a moment. So you have the two items. You have the first part, which is basically the assets. Down there, you have your equity and your liabilities. So your eyes, assets, basically, it's things that you are able to see. We see a number of people, we see their houses. They live in good houses. We see they drive good vehicles. Those things that we're able to see are assets. But down there, this is where now rumor mongering and or gossip is. The question is, who owns these? Who owns? Or the right question would be, how were these assets funded? How were they funded? These are the questions that we would ask. Who owns and how were these assets funded? If someone has a vehicle, how did this person buy this vehicle? This is why now we say he used his own money, meaning you're actually talking about equity. It's things now that you hear. I'm told that he used his own money. I'm told that he went into Satanism. This is why he has all these other things. That is where the gossip starts. Or even if you see all those houses, you see, Alinankongole has so much debt. Then it explains how these assets were funded. So ideally, what happens is that if you cannot explain how your assets were acquired, that is where corruption comes in. So you should always be able to explain how these assets were acquired. If it's not from your equity, from your genuine resources, then you must have borrowed. And this data must be verifiable, isn't it? So like I've told you, when you're looking at your financial statement, always think of your eyes and your ears. And at any given time, it should balance. So whatever you grow up here must be funded by this. So the last part of your balance sheet is basically about funding. So this is why you have your assets, control, past event, inflow of benefits. Then you have your liabilities, which I've already explained in that thing. Present obligations, your past event, outflow of benefits, and all that. The equity part, that is basically your own money. Has there been, so when you look at the income statement, really, you're actually looking at it whether there has been an increase in asset. Because your property, plant and equipment in there, your fixed assets or what you call non-current assets now, that is what you are actually using to generate income. So when you have these machineries, you have your working capital, you start working, you expect to start getting your income. But as you get this income, you are also spending on a day-to-day running of your organization, which is basically on the expenses. So what you get the difference, if you are doing the correct thing, obviously it will be profit. So profit is excess income over expenditure. Whereas the other one is excess expenditure over income, which then now becomes a loss. So the expenses are meant to reduce in the asset. Because you are taking out cash, it's an outflow. If it's depreciation, what you're actually saying, that you are reducing the value of the asset, because it's still an expense. But obviously it's a non-cash item, but it is there to eating into the value of the asset. Then you have increase in liability. So this increase in liability, you're borrowing this side to spend the other side. So your obligation starts growing. Recognition. So when you look at an asset, obviously the first thing that we need to look at, obviously when you start looking at I-16 on property, plant and equipment, you will learn in details about these, about the assets. But we need to know that an asset is something that is of value to the organization. But then you need to go further in defining what this asset is. It should be able to give you future economic benefits, or it's probable future economic benefits. Meaning that when you're buying it, you expect to get some benefits from it, but doesn't usually turn out to be that. Therefore, at some point, you have to think of maybe selling those assets. So the inflow of economic benefits to the entity is probable. You should be able to measure these assets. What you cannot measure, you cannot account for. And therefore, it is not going to sit in the financial statements, because in the financial statements, there are numbers there, meaning that you should be able to value. You should be able to measure the value of the asset. So you can look at the cost model and be able to measure the assets fairly. Or the revaluation model, which we'll be looking at as we move forward. So on measurements, we have the historical cost, we have the current cost, we have the realizable value, we also have the present value. Historical cost is the measurement basis most commonly used today, measured at nominal or original cost. So if you bought your vehicle at $30,000, that is what you're going to use to measure this particular asset. Obviously, you'll be able to depreciate it, cumulative depreciation from your historical cost, and you will know what value this particular asset is. The current cost. So you're looking at the cost that would be required to replace an asset in the current period. So you're saying in an event that we want to replace this asset, at what value can this asset be replaced? So then you're actually using the current cost model to measure your asset. Realizable value. How much would I realize this if I was to sell it? So it's different from asset replacement, but how much would I realize if I was to sell this? So it's the estimated selling price and the ordinary cost of business, less the estimated cost of completion and the estimated cost necessary to make the sale. So it's basically the realizable value. Then you have the present value. You're actually saying, with this asset, in the next 5 years, I expect so much volumes of revenue, of income from this asset, or net income, for the next 5 years. But I have to discount it today so that I'm able to value this particular asset. So you start using present value. This is how we value even bonds in corporate finance. Capital maintenance. So financial capital maintenance. You have also operating capital maintenance. Here, basically, you are just looking at the maintenance. These. Chinzi, how are you?
I'm fine, Coach. How are you?
I'm fine. Be around. Listen to this lecture. We'll be done in the next 5 minutes. We'll get into another lecture. Maybe you appreciate one or two things. Financial reporting, huh?
Okay.
Mm-hmm. So we have regulatory framework. When you are setting, because we are saying when you are setting these accounting standards, you have a conceptual framework, which we have actually looked at. Under conceptual framework, we have actually said, with this conceptual framework, it helps you to come up with new standards. It helps you to enhance the new standards. It helps you to know what information has to be contained, which would actually help the users of the accounting information to make the rightful decisions. But it also prevents crooks from using the accounting information, from using those lacunas or the gaps that the standards have in coming up with what we call creative accounting. And we saw a number of companies like Enron going down, Parmalat going down because there's a lot of creative accounting. But then you have also have a regulatory framework, the need for regulation. So it's to ensure that the needs of the users of accounting information are met with at least a basic minimum of information. So those needs have to be met. The information that is given, at least you should be able to compare it, and it should be consistent. You cannot change the accounting standards along the way. You cannot compare one company that uses different policies. For example, this company uses FIFO. You are using LIFO in valuing inventory. Then you want to compare two companies. You will get different results. To increase users' confidence in the financial reporting process, to regulate the behavior of companies and directors towards their investors. So this is why you need to have this regulated framework. And Zika is, is mandated under the law to regulate in a way like supervising. So I think financial reporting standards on their own will not be sufficient to achieve these aims. In addition, there must be some legal and market-based regulation. So this is how now you bring in the legal issues. National regulatory framework for financial reporting like Zika. So there are many elements to the regulatory environment of accounting. A typical regulatory structure includes one, national financial reporting standards. We don't have them. In Zambia, we had what we used to call at the other side, they used to be called IS what. Then they had that Zika. But when you check the standards, they were just plagiarizing without even changing a comma. So we have adopted the financial reporting standards, or international financial reporting standards. National financial reporting standards, they are not there. National law, yes. Market regulations like Lusaka Stock Exchange and the like. So, Yvonne, this is basically the flow of how the standards are, the regulatory standards are done. You have the IFRS Foundation. These IFRS Foundation, they appoint members under the IFRS Interpretations Committee who interpret the standards. Then they also have what you call IFRS Advisory Council. They appoint those. Then down there you have the IASB. advising the IASB, then preparing and issuing the standards. So this is how the standards are issued. So thank you so much, Yvonne. You will just need to sign up on our website. This lecture is actually going to be, let me just do this, sorry.
Okay.